Peter Lynch, the ace figure in the investing world, called the story-based investor.
His mutual fund had the best 5-year record in investing, and soon he would become a household name.
Do you know notable phrases that resound in the investing world? Invest in what you know. Much needed truth, isn't it? Another one for you. An important key to investing is to remember that stocks are not lottery tickets. Sounds familiar? Okay, one more. Behind every stock, there is a company. Find out what it's doing. Yes, all these famous lines were by the legendary and the most successful investor, Peter Lynch. He was labeled as a legend for his investment strategies in the financial realm. Throve as a manager of Magellan Fund at Fidelity Investments. The assets under his management rose from $18 million to $14 billion during his office term from 1977 to 1990. Oops, that's a whooping score in a short span of years.
We're about to buy the largest block ever in the history of the American Stock Exchange. We bought, 10 or 15 million shares.
Now let's dive deeper about this eminent capitalist, otherwise called the story investor, Mr. Peter Lynch. The 1940s decade can be divided into two great phases. 1. The Germans' obstinate ambitions to rule the world and its disgrace by 1945. 2. A rapid rise in technology advancement, from jet engines, initiatives for space exploration, radar, nuclear fusion, rocket technology, frisbee, Velcro, Tupperware, Slinky, Jeep, and many more economical supportive developments, which in turn brought a chain reaction of job openings in the USA. A decade where babies were made in a racing game. They were called as Baby Boomers generation. So Lynch is from a Baby Boomers generation. He was born on January 19, 1944, in Newton, Massachusetts. In 1951, when Lynch was just 7 years old, his father was diagnosed with cancer. Then he lost his father 3 years later. To support the family, his mother worked, and Lynch from his early teen years worked as a caddy at an upscale golf club.
It's very hard to get a job when you're 11, 12, or 13, but as a caddy, I was able to work, quite a bit, make some money, help the family out.
As a caddy and around wealthy investors, Lynch was all ears to their conversations, who discussed prospects on their shares and their strategies. These discussions showed a great deal of enthusiasm about stocks to Lynch. Initially, the stock names puzzled him. After returning home for the day, Lynch searched for these stock names in the newspaper. When he read in papers about profits of each stock, it raised his spirit. He started to keep track of the progress of his favorite stocks. Observed how the stock market worked. It was a period where the stock market was performing exceedingly well. On partial scholarship, Lynch attended Boston College. He saved money from his caddying job to pay for his education, and the rest he set aside with the hope to buy shares. The air cargo industry caught his eye. In his sophomore year, he bought $300 worth of Flying Tiger Airlines. With the ongoing Vietnam War, Flying Tiger freight planes were used to carry soldiers. The stock later rose to $80 per share. He used his profits to pay for his education. In 1965, he graduated with a degree in finance, and in 1968, he graduated with a Master of Business Administration from the Wharton School of the University of Pennsylvania. His caddying years helped him with great contacts. Among them, it was D. George Sullivan, the then president of Fidelity, who gave him an opportunity as an intern with Fidelity Investments. He caddied for the company's president for 8 years.
And it helped me get a job at Fidelity. When I was applying for a job here, there were 75 applicants for 3 spots. I was the only one to caddy for the president for 10 years. So I got one of the 3 spots, and I worked there for the next 21 years.
Here, his first task was to watch for the paper, chemical, and publishing industries. Then left for 2-year Army service, and back in 1969, Lynch was permanently hired by Fidelity. This time, Lynch was a market analyst. He observed the chemical industries, textiles, mining, and metals. Having followed consistently the stock game, Lynch learned the nuances of the stock market. His first salary was $1,300 per month, and then in the second year, it was $1,400. His diligent performance promoted him as the Fidelity's Director of Research in 1974. After 3 years as a director, Lynch became the fund manager of Magellan Fund in 1977 at the age of 33. Magellan was a small aggressive capital appreciation fund, mostly investing in the domestic market. It was created in 1963. When he took over the office, its worth was $18 million in assets. There were no restrictions on what assets he could buy. He researched his stocks on his own. Initially, he decided to focus on individual companies with large U.S. companies, and slowly sliding to smaller and international stocks. His research list was of the top 10 stocks that showed good prospects. Guess who made it to the list? The Taco Bell! Who knew then about this budding small restaurant chain? Hence, Peter Lynch assembled quality stocks on the Magellan portfolio. At the end of 1983, Magellan's asset value shined close to $1 billion. Back in these days of 80s, mutual funds weren't much sought after. People had knowledge about stocks and promoted stock dealings. Mutual funds were operated by individuals on a trial and error basis until then. It was Peter Lynch who carved a place for mutual funds in the world of finance. He often quotes that an individual investor has good potential in making money than any fund manager.
I'm amazed that the average investor is out there in some industry. They're in the polyvinyl chloride industry, they're in insurance, they're in textiles, and they're going to see those industries turn. They have a big edge in me. I work awful hard, and they're months ahead of me. They can be in the healthcare industry, they're seeing new products. They should work on that they have in front of them.
They have more good chance of spotting good investments from their day-to-day lives even before Wall Street gets that knowledge. In fact, he recalls in his books that most of his major smart investment decisions were formed not in his office or reading any analyst report or trade publications, but rather from his personal experience with the company as a customer. Many good pieces of advice came from his wife, who did the household shopping and notified him on customer trends even before professionals did, a spectacle he called street lag. He self-educated himself about the power of compounding effect over the long run. It was Peter Lynch who unveiled potential businesses like Dunkin' Donuts, Pier 1 Imports, and Taco Bell to the marketplace. In his book, One Up, he narrates how he invested in Dunkin' Donuts. One fine morning while sipping a delightful coffee at Dunkin' Donuts, Lynch's mind kicked millions of thoughts. First, he was impressed with their service. Second, observed that the outlet center was serving at the busiest part of Boston, which will never run down with customers. This led him to analyze the company's financial status and decided to invest in Dunkin' Donuts. It became the best performing stock that he ever bought. All of these were experienced in person, rather than reading from a Wall Street journal. While at Magellan, the financial world descended in a market crash in 1987. Lynch revealed he was well prepared for dire situations like these. The first he did was that he took a long vacation. He didn't panic, nor did he sell any holdings. The market crashed with more than 500 points in a short span of 10 days to a few weeks. And at the Magellan Fund, the asset value drained to 1/3. Nonetheless, Lynch was firm. He played the game well as he focused on the fundamentals. He had thoughtfully invested in companies after carefully studying their progress on balance sheets, their profits, their losses, business model, and its fundamentals before purchasing their stocks. He believes in investing in the long term. Lynch chose assets that were undervalued by Wall Street. Peter Lynch is tagged for creating the concept called price to earnings to growth (PEG) ratio, a basic formula that divided an organization's price-earnings ratio and its growth rate. According to Lynch, companies that were of a low growth rate than their price-earnings ratio were always undervalued at the stock market. He began to explore these undervalued companies and invested in them. If they glided in their own growth phase, he continued to deal with their stocks. Once they reached their peak, he traded their shares and moved to invest in other growing companies. He was unconventional in his trading practices, such as buying more stocks than usual. When he was handed the Magellan Fund, it had about 60 stocks. He was asked to bring down the number to 25 to 30, but Lynch acquired hundreds of stocks, which he believed as good deals. It was unusual to own multiple stocks from the same industry. By 1989, Magellan was holding close to 1,400 stocks. He preferred stocks that had sustainable growth. When an investor placed $1,000 into Lynch's fund box, the investor would have had $28,000 at the closing of Lynch's 13 years of service. In Lynch's management, from 1977 until 1990, Magellan Fund's average return was 29.2% per year, surpassing the S&P 500 for all but 2 years, and as of 2003, it was the best 20-year return among any mutual fund ever. His choice of stocks was from a wide range of industries. In his Beating the Street book, he lists the most profitable picks were Fannie Mae, Ford, Phillips Morris, MCI, Volvo, General Electric, General Public Utilities, Student Loan Marketing, Kemper, and Lowe's. When he left the position and the firm after 13 years, its worth was a whopping $14 billion in assets, with more than thousands of individual stock positions. These numbers are etched in history. Until mid-1981, the Magellan Fund was not open to the public. Lynch retired at 46. However, he was sustained as a senior advisor at Fidelity.
Why do you pick up and quit at 46?
It was a funny decision because I loved what I did. I loved my fund. It's sort of like a hot fudge sundae indicator. I mean, 1 hot fudge sundae is good, 2 is not so good. When you have to eat 7, you sort of approach nausea. You can't run a fund half speed. You can't run it at quarter speed. You either run it full out or you don't. I had to come to a decision saying, what I want to do the next 20, 30 years. And I decided, this was not what I wanted to do.
As of 2006, Peter Lynch was a self-reliant wealthy man with a net worth of $352 million. Often compared to a chameleon, he sailed his ship by adapting to various investment styles that marvelously worked in several financial circumstances. He admits his risk-taking methods while as Magellan Fund manager, but never wallowed with a losing year. He says in his 13 years in Magellan, the market went down 9 times with 10% or more. So did his funds too. But it wasn't a concern for him because he had always planned for the long term. The essential facts for a significantly profitable investment lie upon first, an individual's straightforward do-it-yourself research work, and from there build a profitable investment portfolio. Being an extensive researcher, Lynch was called a story investor. He builds actors like, what is the company doing? What will the company do in the future? What is it doing to achieve its goals? And more parameters to it. Second, one needs to understand the fundamentals of each company, where they want to invest because each stock has a company behind it. The stocks are the players that play the game based on how the company performs. He emphasizes, stocks are not lottery tickets. Lynch categorized the stocks into 6 types to base what kind of returns one should expect. The fast grower, stalwart, slow growers, asset plays, cyclicals, and the turnaround. The only stock Lynch refuses to buy are the hot stocks. In his book, One Up on Wall Street, he quotes, "If I could avoid a single stock, it would be the hottest stock in the hottest industry, the one that gets the most favorable publicity, the one that every investor hears about in the carpool or on the commuter train, and succumbing to the social pressure often buys." He argues once the hot stocks reach its pinnacle, it loses its value rapidly, and that the investors will realize it has nothing to grow further. In the end, Lynch punctuates, invest in stocks that you understand well. He has penned 3 top-selling books on investing, co-authored by John Rothschild, named as One Up on Wall Street, Learn to Earn, and Beating the Street. He is known to be a generous benefactor to the Boston community. Lynch has written a series of investment articles for The Worth magazine. He and his late wife, Carol Ann Hoff, co-founded the Lynch Foundation. He gives monetary support through their Lynch Foundation, Fidelity Charitable Gift Fund, and 2 other charitable trusts. The Lynch Foundation supports religious organizations, cultural and historic organizations, education institutions, hospitals, and medical research centers. Lynch Foundation donated $20 million in 2010 to establish the Lynch Leadership Academy, LLA. LLA provides research and training programs for school principals at BC's Carroll School of Management Business School. Also, the Lynch Foundation was one of the first major supporters for prestigious programs like Teach for America, Partners in Health, and AmeriCares. In 1991, Lynch was inaugurated into the Junior Achievement U.S. Business Hall of Fame. In 1992, the National Catholic Education Association honored Peter Lynch with the Seton Award. Lynch is an inducted member of the Harvard Medical School Board of Fellows. As of today, there hasn't been any articles or news that has surfaced for any infamous acts, to the least, bearing the name of Peter Lynch, unlike other reputed investors like George Soros or Jim Simmons, and the list goes on. Peter Lynch sets himself apart in the financial world with his professional ethics. His strategies were and are simple, sturdy, and its efficacy is well experienced in the long run. Hey all, thank you for watching till the end. Do like and share. Keep watching our videos. Subscribe for more financial documentaries. It's ciao from FinDoc and team.